All right, let's get right into it. In the middle of all of the economic noise, sometimes just one number can pop up and change the entire conversation. And today, we're talking about a number that just started flashing a huge warning sign, one that has economists and investors really sitting up and paying attention.
So you've got this one figure, and it might have just changed everything for the U.S. economy. It's a number that suggests that whole slowdown we've been hearing about for months isn't just on the horizon anymore. It's here. So, what is this game-changing number?
And there it is, minus 32,000. That's the net change in jobs in the U.S. private sector according to the latest ADP report. And what that means is, for the first time in a while, this isn't just about hiring slowing down. We're talking about actual job losses.
Now, you might be thinking, okay, what's the big deal? Well, think of it like the check engine light in your car. When it comes on, you don't ignore it. It's a clear signal that something under the hood isn't right, and you need to figure out what's going on fast. You see, this number comes from the ADP report, which is based on real payroll data from tons of businesses. And why it's so critical right now is because it's super timely. With the official government report facing delays, this is the best, most current sneak peek we have. And historically, it's been a really, really reliable preview of where the economy is going next. And look, we're not just talking about a little blip here. The analysis is pretty blunt about it, basically saying that when you see job losses at this level, it's almost always a sign that the economy is shrinking. It's a classic textbook recession signal. But here's where it gets really interesting. If you just look at that big headline number, you miss the real story. We've got to peel back the layers here, because what's happening underneath is fascinating. It's almost like two different economies are at war with each other. Okay, so check this out. It's a total split. On one side, you've got the small and medium-sized businesses, the backbone of the economy, and they are bleeding jobs, shedding 60,000 of them. But then you look at the really big corporations, and they're actually still hiring. This is that K-shaped dynamic people talk about, where the big players are doing okay, but everyone else is really starting to feel the pain. And where are these jobs disappearing from? Well, it's in the places you'd expect when things get tight. We're talking restaurants, hotels, business services, even finance. These are the sectors that get hit first when people and companies start getting nervous and pull back on their spending. And this brings us to the most crucial point of all. For months, the one thing everyone pointed to was the strong job market. It was like the last pillar holding the whole economy up. Well, this report is telling us that pillar is now starting to crack. This isn't a prediction anymore, it's actually happening. So when a warning light this bright starts flashing, it doesn't just change the economic forecast. It completely changes the game plan for investors. You can't just keep doing what you were doing. It's time to switch gears and pull out the defensive investment playbook. And this playbook is all about making smart moves in 4 key areas. We're talking about bonds, stocks, currencies, and commodities. The whole idea is pretty simple. You want to dial down your exposure to risky stuff and move toward things that tend to be safer when times get tough. All right, so what does that actually look like in the real world? Let's break it down asset by asset and see exactly how you'd make that big pivot from growth and risk to safety and security. Let's start with stocks. The big move here is something called sector rotation. It's basically a shift from buying wants to buying needs. You want to dial back your investment in companies that sell things people want, like new cars, fancy vacations, luxury goods. Instead, you lean into companies that sell things people need, groceries, household products, medicine. Because let's face it, no matter how the economy is doing, people are still going to buy toothpaste. And you know what? It's kind of the same story with commodities. If the economy is slowing down, that means less manufacturing, less travel, and less demand for things like crude oil. So that becomes less attractive. But what do people buy when they get nervous? Gold. It's the classic safe haven asset that investors flock to when things get uncertain. Okay, so this table basically lays out the entire game plan in one spot. You can see it clear as day. The idea is to put more weight on safe stuff, like U.S. treasuries and gold, while putting less weight on the riskier things, like high-yield credit, oil, and those want-to-have stocks. It's a full-on defensive posture, and it all started with that one jobs number we talked about. Now, obviously, nothing is a sure thing. This whole playbook is about playing the odds. The analysis breaks it all down into 3 possible futures for the economy. And which path we actually go down, well, that really depends on what the next batch of data tells us. So the most likely outcome, with a 60% chance, is what they're calling a slow session.
Basically, a long, sluggish period of slow growth that just feels bad. Then you've got two other options, each with a 20% shot. Either things magically bounce back and this was all a false alarm, or things get a lot worse and we see a real cascade of layoffs. But for now, the odds are clearly pointing to a slowdown.
So how can you track this for yourself? It's actually pretty simple. You just have to watch the next few ADP reports. If the job numbers hang out in this kind of mediocre zone, somewhere between losing 50,000 and gaining 40,000, then we're probably stuck in that slow session. If we see a big rebound above 100,000, that's fantastic news. But if we see losses get worse, dropping below 100,000, then it's time to really buckle up.
So there you have it. The warning shot has been fired. The defensive playbook is on the table. We know exactly what signposts to watch for. Now, the only question left is, which one of these futures are we actually heading for?